He's the chief U.S. economist at JPMorgan. Mike, it's good to have you back. Why do things look so much worse lately? What's the biggest delta, so to speak?
Well, one thing we've learned is just the extent of the number of stay-at-home orders around the country, which is extending where we're seeing weakness from. You know, before we had thought it was consumer spending on things like airlines and so forth, and now it's just the overall economy is shutting down, even sectors that aren't directly related to the virus. So that's what we've learned. I mean, we also, of course, saw that unemployment claims number last Thursday, which was continues to be shocking if you look at it. We expect something similar again, unfortunately, this Thursday.
Right. And now we have anecdotal data about, jobless claims offices just being totally inundated. So you were saying that the biggest change is that these stay-at-home orders are effectively shutting down the economy, not just consumer spending, but as our Phil LeBeau reported, there's no major automaker that has, its production lines open right now and so forth. When this lifts, and again, maybe it's going to be a rolling lift, but does that activity spring right back? How are you guys anticipating this recovery will look like?
Activity should come back, should spring back, yes. I think in the third quarter, if everything goes according to plan, we could see double-digit growth rates. But keep in mind, that's a growth rate. I think it's important to think about levels here. So if you want to think about the unemployment rate, I think we and everyone really expect a big spike in April and May. And that should start coming down in the second half, but we still think by the end of the year, the unemployment rate will be substantially higher than where it is now. And I do think even if we have activity springing back, there's going to be some lasting damage in terms of weaker balance sheets of both businesses and households, destroyed job matches. And so that will take time to repair.
Right. And we know this Friday we get a big number. It's going to be the March unemployment report. But plenty of people have pointed out the survey period, the week that includes the 12th day of the month, was before a lot of the stay-at-home orders hit. So maybe the report, quote unquote, won't look that bad. In fact, people are struggling to find a piece of data that really well sums up what's happening in the economy right now. What kind of alternative or traditional data points are you most focused on right now?
So I already mentioned the jobless claims, and I think for a number of weeks that will continue to be the marquee report on the state of the economy. We've also been looking at some other high-frequency big data indicators, but most of those have become they were interesting at first, so watching things like NBA attendance and restaurant reservations. But when those all go to zero, it's kind of not really all that informative anymore. So we're really still focused mostly on jobless claims, at least for the next few weeks.
Wow. I mean, that tells you a lot in and of itself, that there's, no alternative data, no big data, so to speak, to really aggregate anymore. So I guess the final question becomes, policy response. The president has already been talking about maybe an infrastructure package could be phase 4. We've already passed the first 3 phases of stimulus. The Fed has done quite a lot, but they've actually had to slow some of the mortgage purchases to not mess up that market too much. What more is needed, do you think? What more is expected?
So I think it is likely that more is needed, particularly the aid to states and localities may be insufficient. I think it is actually sensible to start thinking about infrastructure, even though the shock could be short-lived in a number of months. The weakness in overall economic activity could persist. So, putting in place something now that provides support to the economy in a year or so's time, which is what an infrastructure bill would do, is actually somewhat sensible when you think about, for example, how long it took to return to full employment after the last recession. So I think having some added aggregate demand in the pipeline for 2021 is actually starting to look like a good idea.
Finally, Mike, how long before you think we get back to what the previous GDP growth trend was?
So if the experience of the last recession is any indication, it could be never, right? So I don't think anyone would expect us to return to potential growth estimates that prevailed in 2006 or 2007. So I do think there's going to be some lasting, loss of output, permanent loss of output here. That said, I do think with the right policies, we can get back to full employment by the end of next year.
By the end of next year for full employment.